Today, I'm going to talk about risk management. It is the beginning of something quite different from what we have done in this course up until now. So we are going through the equator of the course. Up until now, we've made certain assumptions, which is everybody works for free. We are looking to understand the universe as a as an exercise in reflections. Every price here reflected by a price there. That's all great. It's going to give us a tremendously useful toolbox to get closer and closer and closer to the industry. So today I'm going to be perhaps the closest to the industry that we will ever be in this course, because I'm going to give you an overview of what's happened in the industry for the last 100 years, so you understand where we are now and hopefully where we're going. I will end up with some science fiction today. And then, once we do that next week, I will devote all of the lecture to developing credit risk, both as risk management as well as revenue, trading revenue. And the reason is that I suspect most of you, probably as many as half of you who will be working in the financial sector, will be closer to credit than perhaps anything else today. In a few years, I cannot predict. And then we'll move into investments, and that will be perhaps the end of the course. So today is that 100-year perspective on that. And I like to address this as 100 years of failures. By the way, the lectures of today are on the website. I just uploaded them before class. You can download them if you need to. I like to look at the 100 years of failures because a lot of what has happened in the financial sector is a consequence of failures of some sort. I'll explain. You will understand. So I have here a picture of, I think it's the Dow Jones, since the year 1900. It's hard to find an index that goes back such a long time. The Dow Jones does. I have no particular interest in indices today. It's just I want to give you a picture that summarizes what happened over the last 100 years. And you probably there, you know that the financial sector is a lot older than that. I already told you futures were created in the 17th century, towards the end of the 17th century in Japan, with the rice market, but we're not talking about that. Bonds came after that. Bonds really exploded with the expansion of the railroad in the United States to the west. That required significant amounts of capital, and it was done mostly through bonds, but I'm not talking about that. I want to talk about stocks, not because I have any predilection about stocks, it's that this picture explains best the history of the financial sector as it's relevant for you. I will start with 1929 and the crash of 1929. Some of you may know more and say, wait a minute, in the year 1900, Bachelier did something very interesting. And I will tell you, I don't care. Today I'm very driven by business, and what Bachelier did for business was not relevant in the year 1900. It was relevant later, but not now. So 1929, the crash of 1929, I don't know how much of that you know. It's a fantastic piece of history. It was important, but it's important because it gave rise to financial markets as we know them today. One of the big consequences of the crash is that, for example, accounting standards were developed. As we're going to see today, financial markets were not very trustworthy before 1929. That's part of the reason why the crash happened. There were lots of other reasons. We had all the horrible fallout of World War I. We had other things, but what is relevant for us today is that the 1929 crash gave rise to financial markets as we know them today, with trustworthy accounting standards, and therefore the ability to determine the price you want to pay for a stock transaction for example, which is based on numbers and not based on fiction. But note computers did not exist back then, so the concept of a number is not the concept of a number we have today. And then came one of the most volatile periods ever in financial world history. I'm looking at the United States here. I'm not looking at Europe, not looking at Asia. Everything here was focused on the United States. And this was there were a lot of things happening here. You had the Vietnam War, the Korean War, then the war, the oil war with Iran. It wasn't a real, it wasn't a war with bombs, but it's a tremendous volatile period where things were extremely volatile, tremendous inflation and tremendous shortages of oil with all the impact it had on industrial development. Just to give you an idea, there's a number here, which is that during those years, there used to be 6 bank failures per year. In 2022, we had 2, maybe 3 bank failures. Remember, Credit Suisse? That wasn't really a failure. It was just they were absorbed by UBS before problems developed. We had Silicon Valley Bank. That was a failure, but of a relatively small bank, not a Goldman Sachs. But in those periods, we had 6 bank failures per year. You can imagine what that was. Next week, I will start with a case that happened around that time, 1982. We'll understand that a little bit better. Right now, let me just continue by saying that this is what gave rise to derivatives. See, derivatives, if you have a market which is nice and calm and this and that, what do you need them? We went through a lot of examples of derivatives here. And the derivatives make sense when you have price uncertainty. If you have certainty, who needs derivatives? You should know no one does derivatives because they are cool mathematical objects or because you want to program something in Python and you don't know what. All of these products exist because of financial reasons. Financial reasons mean that someone makes money and someone saves money. So when you have markets like that, you can bet that there was a lot of appetite for certainty. And if you can achieve certainty with options, why not? And this is why options, derivatives, indices, futures, and all of that developed and they blossomed, because it gave financial participants a way to address all of the uncertainties and volatile times of the market. You understand that? And that was, a lot of that happened around the 80s. Around the 80s is when there was a very interesting sociology development, which was that a lot of mathematical talent went into Wall Street, mostly from schools in the Ivy League. I was there. As a mathematician, I decided to stay a professor, but a lot of my students, my colleagues, they went into the financial sector. The flow started then. And then something happened. On October 19, 1987, there was a crash, a very big crash. 25% one-day drop in the S&P 500, bigger than 1929. And this event is, I would say, the reason you're here today. So I want you to understand it. A lot of what I will be talking about today is because of that one event, October 19, 1987. You can think, have you ever heard about that one day, October 19, 1987? Anybody knows? You know about that? Who knows? Do you know about that? Okay. It was actually a non-event after the fact. The market recovered, and it's very hard to go back and find any real significance as to why that happened. But there was a Brady Commission put together to understand what happened. People need to understand what happened here. Many companies went bankrupt because of that. And I'll summarize the findings. The findings were that computers had started to look for arbitrage in the market. It was one of the early days of computer-driven trading, but you've seen what we've done here. You can imagine that this could be programmed into computers. Python did not exist. A lot of those programs were done maybe in C, probably likely in Fortran or something even older, Pascal, who knows. It didn't matter, computers were taking parts. And things that looked like arbitrage ended up being creating a lot of activity in the markets that gave rise to that one-day crash. It was created by, and all of that was option trading. So that what central banks got together, banks got together, and people started to say, well, what happened here? How can we prevent this from happening? And the discovery was very significant for you. We're going to see a lot of what was discussed in those meetings today. What came up was that we needed to understand derivatives better, and regulation was created. And this is what I'm talking about today. Okay. After that, we have September 11 and the demise of Enron, which had another consequence that was that quantitative easing took place. Quantitative easing is basically central banks giving liquidity to the market and say, don't worry, I'll lend you money if you need it. Okay. And the idea was to not stop economic development. But it was so, money was so cheap that structured credit developed. We'll talk about credit next week. So for now, this is just something which is there. Credit products, for example, mortgages exploded. The amount of mortgages exploded in a good way, in the sense that the volumes grew and grew and grew, and it looked like finance had discovered free money. And money is not free. Money stopped being free before reading week, I told you, right? So today we're dealing with reality. And then 2008 happened, the big crisis of 2008, which I will explain to you in some ways towards the end of the course when I talk about investments, not today. And all of that, the summary of all of those 100 years is a relationship between events and regulation. That's what I want you to understand today. Every time there's an event, there's a regulation that comes with that. So from 1929, where we have the Securities Act from 1933, it came a few years after that. This has had very little impact in you being here, but this is what created investment firms in the United States. This is what created stock indices and regulation. This is what created the Securities and Exchange Commission and all of the regulatory bodies in the financial markets. It was a consequence of that, okay? 1987 is what happened, and this is the creation of a BIS-1. This is the first treaty for risk management, which is the one created by the Bank for International Settlements, and that's very important. I will describe that today in some summary form, as usual, but this is the reason you're here today. This is what caused for mathematics to enter the financial sector, and I will explain that today carefully. Then we had August 1998 that gave rise to BIS-2. This is the regulation for credit risk, not for market risk. BIS-1 was market, BIS-2 was credit, and that will happen after October 1998. I'll just summarize October 1988 to you with two events that happened the same week. Bill Clinton got impeached in Congress. Remember that? Monica Lewinsky, rings a bell? Okay. And the same week, we had the default of the Russian bond. That dried up liquidity in the markets and created long-term capital management to blow up. Investors lost all their money, but the portfolio they had was so big. In notional, it approached $1 trillion, which back then was a lot of money. Now it seems that it's not so much money, but back then was a lot of money. So that gave rise to a new wave of regulation, which I'm not addressing today. I want you to know that these things never end. Then 2001 with Enron, and the regulation that followed, which is the Sarbanes-Oxley Act of 2002, which I'm not talking about today. But every time something happens, there's some reaction to that. 2008 gave rise to Dodd-Frank, that was brought forward by President Obama in the United States, then mostly repealed by Trump in his presidency after that. But there's always like that. And these are things that banks are forced to do. Banks may do things because they like to. They like to make money, or banks may do things because they have to. And there's a big difference. Everything I'm talking about today will be things that the banks have to do because they have to. They've been told they have to do, they have no choice. And that is going to have a very big impact in terms of the necessity of banks to do certain things. I'll explain. Something that has not happened yet is a big data event. Hasn't happened yet. But when that happens, we'll probably see that data regulation will take hold. Right now, as you know, the data is not unregulated. It's regulated in different ways, regulated differently in North America as it is in Europe or it is in Asia. Okay? And the reason is that we are being proactive in terms of understanding what data problems we could have. But the fact of the matter is that data is largely unregulated yet in finance. Okay? In other areas, data is regulated different. For example, in the airline industry, it's regulated differently. Every plane has a black box, for example. COVID-19 did not give rise to regulation. And I don't know if it will or if, I don't know, but it's one case that it didn't. And this is very important, and I'll be talking about this today. There's another event which is also preemptive, which is the Paris Accord. You probably know about the Paris Accord. In 2015, 193 nations decided that climate is an important risk and they want to do something to. I'll be talking about that today also, but I just want to draw your attention to one of the articles in that accord, which is Article 2.1c of the Paris Accord, that basically says that finance would be, that governments and companies will use finance as a way to address climate risk issues. And this is the reason why climate finance is important today, because finance has been dictated as the tool that will be addressing and hopefully finding the solutions to these issues. Okay, I'll talk about that more today. Now, if you look at the 100 years of risk analysis over time, in 1930 there was very little activity on risk analysis. The best was what we now call value investing. Find a good stock and buy it at a good price. That was basically it. Markowitz is the first one who introduced the concept of risk successfully. I'm sure other people did it before and then after. But Markowitz had a very important timing element to his advantage, which is that he started to talk about risk at a time when computers were invented. And then he introduced applications for what we now call time series. Imagine doing time series without computers, by hand. Can you imagine that? Not very useful, right? Well, his theory was very much aligned with the developments of technology, and we now know that technology plays a very big role in the development of just about everything, including regulation. Then, the fact that everybody, by the year 2000, just about everybody had a computer on their desk and a computer in their pocket, that meant that quantitative techniques, computations, algorithms were everywhere. And that created the need for people like you to go and dominate that world. But now something is happening that I want you to be aware, and I will also end with this, and that will be the science fiction part of my class today, which is that from an infrastructure perspective, from a technology perspective, now we are at a time which is perhaps as significant as 1950. Okay, 1950 was before and after computers. From 1950 to the year 2020, we had computers everywhere, and like I said, there's a computer in every desk and in every pocket. But all the methods that have been used up until 2020, they all share the same thing, which is that their data has been numerical data. What is changing now is that the data is no longer numerical data only. We have textual data. And this is changing everything. And I will be talking about this today. I'll give you some very precise example of what that change of paradigm will do to finance and the role you yourselves will play in that new world that's coming. It's not there yet, but I'm telling you, very few people understand, but it's coming. Okay, that's going to have a very, very big impact to what will be coming after, and that will be, again, the way I will be addressing this thing today. And in this context, the Article 2.1c of the Paris Accord, you will see how significant it is from the new paradigm, because Article 2.1c of the Paris Accord is something which I will explain to you. It can really not be tackled with numerical data only. You're going to need to have textual data and probably something else. Large language models are around that, you know that, but large multimodal models are coming. And these are the ones that will really drive change. And these are made for you. You will be the generation that will be bringing large multimodal models to finance if you go into the financial sector. And I want you to be aware of that. That's coming. Okay? Okay. Risk. Talking about risk. So very quickly, I'll just give you the risk taxonomy, the classification of different risks. Market risk. That's what we've been focused on for the first half of this course. Everything that markets can do for you, as we saw up until today, was something goes up in price, something goes down in price. Well, that's called market risk, but there's many others. Credit risk. What is credit risk? Someone is supposed to give you some money and they don't. That's credit risk. Liquidity risk is you are the owner of all of the oil rights of Alaska, which is worth billions and billions and billions. But if you need $1 billion tomorrow, what can you do? You can't just sell that, or perhaps not even borrow against that, and that causes losses. That's called liquidity, and that happened. What I told you actually happened to the Hunt brothers, to brothers in Texas when they tried to corner the silver market, for example. That's liquidity risk. I'm not talking about gap risk. And then legal risk is you're so happy that everything is going well, and then something is declared to be illegal. And then what do you do? And these things tend to happen sometimes very quickly. Of course, you're probably watching President Trump changing the rules of the game almost every day. But you don't have to go into something as extreme. There's one case that I like to bring to your attention. That was the case that happened with Bankers Trust. I don't know if I mentioned this to you. It's a case I like to talk a lot about. Bankers Trust was a bank, was very active in New York City when derivatives started in the 80s. And they had a client that was Procter & Gamble. Do you know Procter & Gamble? Okay. Did I tell you about this case? I told you about the case, right? Okay, so now you got to understand that when Procter & Gamble, actually the shareholder in Procter & Gamble, sued Bankers Trust for gambling because he claimed that derivative trading was gambling. The defense that came, that basically showed no, they say replicating portfolio, so there's no gambling, and then the lawsuit basically got dissolved. Imagine what would have happened if that didn't occur. And yes, derivatives were declared illegal, and then billions and billions of dollars would be in an illegal situation. So that's also part of the risk taxonomy, legal risk. Then finally, operational risk, which is somehow like to this day is a catch-all term that if you make mistakes, so fat fingers. Sometimes traders they add one more zero to the trade instructions, and that causes havoc. 1,000 to 10,000 shares of something is not an issue, but from 100,000 to 1 million, it could have an issue. Okay, and sometimes it happens. And cybersecurity, which is one area I'm not talking about at all in this course, but it's extremely important. And I'm not talking about because I have very little to say. It's still out there and not very well known. But this is also the frontier of where risk is. So all of this is a description of risk. And behind every one of these lines, there's a whole line of business. These are things that as I'll explain today, banks and financial institutions do because they have to do that, not even if they don't want to do that. That means that there's jobs which are guaranteed. Someone has to do this. All right. So I have here some examples. I could go on forever on this, but I want to just finish this summary very quickly and then move on to some particular examples that you should know. When it comes to, for example, market risk, is not only a type of risk, it's actually regulated differently depending on the sector you're in. In banking, this is what Basel I is, gave rise to the concept of value at risk, which I will explain today. Very important concept for you. I will explain once I get there. In the case of insurance, this is regulated differently. And for example, this is the content of the solvency capital ratios of the Solvency II regulation, which is very big in Europe. When it comes to credit risk, it's regulated differently, also for the banking and for the insurance sector. And these things are not regulated in the asset management sector, for example. They're not. In the asset management sector, what's regulated are other things. Let me just go quickly to legal risk, for example. Legal risk is somewhat irrelevant for banking and insurance, at least in comparison with the investment sector, with the asset management sector, which is a very big deal. So market risk and credit risk are not really regulated on the asset management sector, and the reason is that they're not considered to be vital to the economy. So regulators go to the banks because when a bank blows up, it's a big impact, it's a big blow to the system. But if some investors lose their money, well, sorry for them, but the impact on the economy is less, and that's why regulators don't go there. However, if you buy and sell stocks, you can do damage if you do them the wrong way, and we'll show examples of that. And that's why that aspect is regulated. And this actually started in the year 1933. The Investor Advisors Act of 1933 is the first example of how in the asset management sector regulation is in full force in certain aspects of that, in the legal risk aspects of that. And most of you will not be involved in that, I don't think. This is an area which is very important for lawyers, whereas a lot of the banking and insurance aspects of market and credit risk is what people with your technical skills typically do. Okay, so because of who you are, I'm not going to talk about this. If you were a different audience, if you are, no one is studying law here, right? No? Okay, then I don't talk about that. But I will make a prediction. Prediction that one or two of you will become lawyers. When you do, send me a message and tell me I was right. Okay? So I can keep count. Yes. Depends on where in the industry you go, you may have to do that. And if that happens to you, don't think that you're weird. No, many of my students have become lawyers. It happens. Okay? Just all right. And cybersecurity, I don't have very much to say. I'll just continue. There are cases that show how important these things are. I have, well, if you're curious, you can ask ChatGPT about any one of these cases. They are very interesting. I'm not going to spend a lot of time on that. Okay, but these are cases that make the headlines when it comes to these particular types of risk. If any one of you is curious about this, you get a job interview and say, oh, I'm being interviewed at certain job somewhere about this. Ask ChatGPT about these cases, and that will give you an idea of how important these things are. Okay, now this is more important now. I'm going to go to the role of the Basel Committee on Banking Supervision, which was created as a way to address all these risk issues. So again, 1987, very important year. The stock market crashed. Bankers got together and said, what happened? What happened? Well, this happened. Trade options we have been traded by computers. And I said, what's a computer? This. Okay, and now what's an option? That. Okay, how can we take care of that? And I'll tell you in your language what the conversation was. The conversation was, up until then, if you're a big bank, then you had to have a piece of your assets as what's called regulatory capital. Okay? You have $100 billion, then 8% of that, 8 billion, you cannot touch. Goes to the regulator, and if something happens, they have that money. It's a way to build a buffer for losses. Okay? But now, imagine the market drops by 25%, and you have $100 billion in assets. What would you expect to lose if the market drops by 25% if you have $100 billion in assets? What do you expect? 25 billion, right? Okay. Well, what if a portion of that is in derivatives, options, for example? Let's go back to the 33-cent game. Yes? The 33-cent game, the stock dropped by 50%, and the option holder lost how much? I remind you, you may have forgotten during reading week. The option holder paid 33 cents. The stock goes up, you get $1. If it goes down, you get nothing, right? So if the market drops by 50%, how much do you lose? You lose 100%, meaning everything, right? The stock drops by 50%, but you lose everything. If the stock goes up by 100%, how much do you make? 300%. So let's say that options are nonlinear instruments, right? Yes? They're nonlinear instruments, they're asymmetric. So it is possible that the market moves a little bit, just a little bit, and you lose a lot of money, right? Yes? Because what options have done to the market is options have made markets nonlinear. And what bankers realize is that linear measures of risk, linear economic capital considerations don't work. So there was a need for a non-linear measure of risk. Understand that conceptually? And that's why you're here. That's how mathematical finance became a big deal. So what the Basel International Treaty is, in our terms, was a nonlinear risk measurement exercise. JP Morgan, always ahead of the curve, proposed a methodology called the risk matrix methodology in 1994. I'll show you some of the elements of that, which will be very easy for you to understand, but then you're going to understand why these professions were created. I'll explain. Then in 1997, January 1st, December 31st, 1987, Basel I was regulated in the banks in the member countries. Canada was one. And all the banks had to have the systems in place. I created my risk lab in 1996 because of this, because there was a lot of need for people who could do programming and finance at the same time. And back there in 1996, those people could not be found. The reason I did my risk lab is so that people with your background would understand what a derivative is and how you can program things. I got lucky. I was part of that development. Okay? But I want you to know, because these things never end, there's always something happening somewhere. And you need to stay ahead of the curve. The rear view mirror is a very bad way to make plans. It's good for me to remember, but I have to look forward. Okay? So don't look for jobs 20 years ago. Maybe look for jobs 20 years from now. That's a bit risky. Maybe a year from now. Right? So I hope this is what I want you to learn today. This is why I'm telling you all of this. You always need to understand what happened when some things are over and what is coming, what's next. If you're looking for a job. If you're looking to do a PhD thesis, well, almost the same, you know? You want to do something which has impact and is significant. And if you're going to go to a master's program, professional master's program, well, you're going to be looking for a job in a very short time. So open your eyes and look at what's happening around you. That's this class today, okay? Now, in 1997, JP Morgan again went ahead of the curve and proposed a credit matrix methodology that when Bill Clinton was impeached in 1998 became very handy and gave rise to London Capital Management blew up, and that gave rise to Basel II, credit risk. And this was very hard to regulate. It was easier to regulate market risk. Credit risk is very hard to regulate. We'll see credit risk next week, and then I'll say more about that. And then in 2017, there was a Basel III that included also operational risk, but very hard to regulate it. In fact, Basel walked back some of the requirements for operational risk. Some of the regulations they came up with are just too sophisticated, too complicated, even with people like you in the market, and they've been removed for being too complicated. And I want you to understand all of this. I want you to understand what complicated means, what easy means, and what relevant means, and what impossible means. Okay? And risk management is the way we're going to be doing that. When it comes to securities securities regulation, very important, but again, this is not so much for you, but I want you to know. The market crash gave rise to the Investor Advisors Act of 1933, creation of the Securities and Exchange Commission, and many of the rules that we now know and are there, they were created then Enron happened, and Sarbanes-Oxley, but again, you're not lawyers yet. One day you go back and take a look at that, and then you'll understand the development of that. Just to give you an idea how asset management was before 1929, there was an area of exuberance. Everybody was buying stocks. It became the thing to have, far, far more than cryptocurrencies today, far, far more. Speculation was tremendous. There were $8 billion, a lot of money at the time, on loan that people used to borrow to buy stock. There was more money lent to buy stock than there was money in circulation back then. So this is how bubbles can occur. The P/E ratio was 32 in September 1929, very big number. And here's my favorite example. Albert Wiggin was the head of the Chase National Bank. When he saw all these problems happening, he shorted 40,000 shares of his own company, making a $4 million profit. This is illegal today. But in 1929, that was legal. You could do it. Right? There are many things which are legal today that may be illegal in the future. How certain cryptocurrencies are promoted, for example. Right now, there is very loose regulation about that. That might change. Okay? But this is an early example of that, 1929. You do this now, you go to jail, like no questions asked, right? There's no way to get out of that. But back then, yeah, no problem. I made $4 million. Of course, I knew my bank was going down the drain. So, yes, 1929. All right. Again, be ahead of that. Then in 1974, the Basel Committee on Banking Supervision was created. Okay, capital was 8% of risk-weighted assets, a linear measure of risk. That's what I told you earlier. And it was defined like that. This is risk management before 1991. Okay, depending on what you have, they apply a ratio to it. That's it. How about derivatives? What if you have what if you're playing the 33-cent game, and if the stock drops, you lose everything? It wasn't there. So that had to change. It had to change, and it changed because of this one day, October 19, 1987. And this is the most important line that I want you to remember for all of this course, which is that this, for the first time, made mathematics become law. I'll show you what math became law. And it is one thing for you to remember of the class today, is that when mathematics becomes law, this work for mathematicians. You don't have a choice, right? You don't have a choice. So maybe what I'm going to do is I'm going to take a break here. This is the most important sentence today. So I think I'm going to take a break now, and then after the break, we take a 10-minute break. After the break, we'll go into the details of that. What exactly happened? All right? 10 minutes. Mathematical concepts made into law. This is a big deal. And I want to spend some time explaining to you the type of mathematical concepts and what that means. I'm going to pick one topic. It's very boring for most mathematicians and most people in mathematical finance, because everybody is very old, and it is too, is very old and very boring. But it is a very good topic for you to understand what it means. So value at risk is a concept developed around that time. It is actually one of the it's one of the elements that was prominent in the risk matrix methodology of JP Morgan in 1984. And it's the following thing. If you have a portfolio is a random thing. It could make money, lose money. So the value at risk of a portfolio with a confidence interval of 95% is that number with a property that the probability that you lose more than that number is 5%. Okay? This is what in mathematics we call a quantile. Let's look at it in some more detail. I'm going to use this to explain to you something. So there will be a mathematical expression of that. Now, the first thing I want you to you understand that, yes? Everybody understands that what is written in English is the same as what's written in math, yes? Everybody understands that? You all know integrals, yes? Okay, great. Imagine I pass a law that says a bank needs to have, with the central bank, an amount which is, say, 2 times the value at risk. Understand that? How many pages do you think that law will have? I'm doing a case. I want you to speak now, okay? Yes.
Sorry, can you say it again?
Imagine I want to pass a law, and the law says that a bank needs to have, with a regulator, needs to have in cash an amount of money equal to twice the value at risk. That's the law. Yes? You understand the quantile, you understand the mathematical concept, right? I want you, you're not lawyers, I want you to understand the legal version of that. If you were lawyers, I'll be spending a lot of money explaining to you what a quantile is, but you understand a quantile. So I want to spend some time trying to get you to understand the legal aspects of that. Imagine, this is important, by the way, okay? The law is very important for many things, and in particular for you, because that's how many of these jobs, this is why many of these jobs exist. So how would you write this down as a lawyer?
Maybe you'd have to figure out what you are actually defining your portfolio to be. Because if you're saying it can be twice this, then what is this?
So you have to go through many definitions. That's the first thing. Okay? The law needs to have very, very good definitions. And then, of course, very precise language. Let's start with the definitions. So you need to define what the portfolio is. The portfolio is kind of easy to define, because the portfolio are the assets of the bank, and those are classified. Assets, obligations, contracts, all of those things are So everybody knows what those are. You don't need mathematicians for that, and they already have lawyers that say, oh, these are all my obligations, these are my contingent liabilities, these are my assets, this is ever, right? So that is already known. So that what the portfolio is known. What else do we need to define?
Risk. What does it mean to be at risk?
No. Value at risk is a term. It's called that. It has nothing to do with the term value or the term at or the term risk. It's called value at risk, okay? And it's defined like this. It's the number that the probability that you lose more than that is less than 5%.
We have to somehow standard this as probability calculation.
Okay, well, I have to say exactly what does probability mean. You cannot talk to a lawyer or a judge in terms of probability, right? The law is not, so well, maybe yes, maybe no. You have to define what probability is. How do you define what probability is legally? How do you define what probability is?
The chance that an event happens.
What does that mean? Now be a lawyer, right? Be a judge. You're talking to a judge now. How do you define probability to a judge, to a lawyer?
But not probably defines through expectation.
Okay, now you have to define expectations, right? Okay, how do you define expectations to a judge or a lawyer?
Is the average value?
Average value, okay, I begin to like that because one thing that lawyers and judges know is average is too complicated, but they would know how to add and divide, right? So you have to have a definition which is I add certain things and I divide by something. Now you need to define what you add and what you divide. So that's a good step forward. Okay, what do we add and what do we divide? That's the next thing now. I need to have a chapter on what I add and what I divide. What do I add?
Like weighted outcomes.
What is an outcome?
Like money you make.
The money I make is the money I make. It's one number. It's I make and I lose, right?
Oh, yeah, we use, yeah.
You're going the right way, but you have to think a little bit more. What?
Variance.
What?
Variance.
Variance. Oh, what's a variance? You know what a variance is in legal terms? With something that's supposed to be this is something else. So it's not going to work. I know what you're talking about, but that's not.
Oh, I was about to say variance can be explained as risk. Or can be explained as
You're having a scientific discussion now, right? Doesn't work. Doesn't work. I mean, you're being lawyers for 10 minutes. It's a good exercise.
Average fluctuation from the average value.
What is okay, average? Wait, we're still trying to define average value.
Oh, okay.
We haven't defined average value, right? She said average value, and we agree that average value is going to be the sum of some things divided by something. You need to define this, the things and the thing. We need to define what's in the numerator and what's in the denominator. Then you have a law. We still are trying to define what expectation is.
Maybe we use the denominator, the numerator would be the number of occurrence with the loss being less than.
Okay, well, okay. So the number, okay, well, this is good. So you're looking in the numerator, the number of occurrence of a loss. Of loss of what? Of that portfolio.
Yeah.
Okay, but I have this portfolio today. So what do you,
Back to the historical times.
say that again? No, you have to speak louder. I'm very far from you.
So we look back to the historical times.
We look back at the historical. Okay, so what you're saying is, I begin to like that. You're saying is that I have this portfolio. If there is a way, I can go back in history and I can measure how this portfolio would have made or lost money through history, right? That's what you're saying. That gives me numbers that can be precisely defined, right? An accounting company, Pricewaterhouse, KPMG, can calculate this. And they can vet that this is correct, and that goes to the judge, right? Okay, so yes, I could do that. You understand? You understand? Great. Okay, but now I take the portfolio, that's very well defined. I'm going to calculate, KPMG is going to calculate how this portfolio made or lost money in the past, right? But how many days, months, years? I mean, I need more definition. What do you mean by the past? How many days? Do we do it daily? Do we do it monthly? Do we do it annually? Every week? Do we look at the value of the portfolio at 10 in the morning, at 5 in the morning, at 7 p.m.? You understand what I'm saying? These are all the parameters you need to define. You see what are you following me? You see how complicated this is? You see how many pages and pages and pages of regulation you're going to have to define this thing that I did with one math equation? Yes?
So there are no like specialized judges for these types of like cases?
No. This is the law. The law is the judge that, no. Even if they were, you can go to a judge with an integral, right? And the judge is not going to do the integration by parts or something like that. They don't do that. You need a very precise number that comes out of that everybody will agree. There will be no disagreement that this is what this number means. Yes? And this is a very simple quantity. I mean, I can imagine doing something. We will do things which are more complicated than this, but something like that became law in the year, essentially 1991, was implemented in 1997. But even after this is declared to be law, then you have another body. This doesn't go to judges, right? There are regulatory bodies. In case of Canada, is OSFI, the Supervisor of Financial Institutions, that actually goes institution by institution, says, show me what you've got. And they check that everything that they have matches this, because not only they have to write this into law. Banks use systems that implement this, right? The supervisors don't know the value of these portfolios day by day of the last 2 years. They trust the banks to calculate the right number. And for that, they have to go and they have to vet the systems that were developed. So someone goes through the code and checks that, in fact, this thing that you have here calculates exactly what it's supposed to be. So there's a whole army of people checking that all of this is actually what it's supposed to be. Do you get a depth? Do you get a sense of the depth of everything that goes into implementing one mathematical equation, which is one line? How many hundreds, if not thousands of people are involved in making that a reality? You get that? Well, that's why you're here. Maybe you did not know that, but that's why you're here. Okay? That's why you're here. So now I'm going to go back into the math. Okay? So let me consider this following portfolio. I have 1,000 lottery tickets, and to the winner, I give $1 million. That's my portfolio. Yes? Understand the portfolio? 1,000 lottery tickets, and to the winner, I give $1,000. So let me see what happens as a function of the number of tickets I sell. Imagine I sell one ticket. One ticket. I only sell one ticket. What's my value at risk with a 95% confidence interval? It's 0. Because the probability that I lose any money is 0.1%, which is less than 5%, so my value at risk is 0. Right? What if I sell 49 tickets? What's my value at risk? It's also 0. What if I sell 50 tickets, just one more? What's my value at risk? It's 1 million. And if I sell all 1,000 tickets, my value at risk is 1 million. Now, you are familiar with the concept of quantiles. You're not surprised by this. That's how quantiles work. But if you're a regulator, what do you think of that?
Value at risk doesn't have to be just 5%, right? It could be like 2.5%.
It's specified in the law.
Oh, it has to be 5%.
It has to be. No. It's whatever the law says. Okay? So there's some cases where it's 5%, there are cases where it's 0.1%. It's specified, it's part of the law. The law that implies, okay? Yeah. So I'm going to go with 5%. It's very common. And I use this example with 5%. So you see that? So does this make you nervous in any way? Anybody thinks this is kind of weird? Yeah.
Because imagine you win the lottery, one ticket.
No. This is a risk management. It's about losing the lottery, meaning having to pay, right? That's the portfolio. I'm using an example, right? I have options and one of them doesn't work. I have to pay a lot. The others are okay, right? So if I have one thing which has a very unlikely probability of happening, my risk seems to be 0 according to this, right? But see, to go from 49 to 50, it's just one more. In fact, I'll tell you more. What would happen if I have 49 tickets, so I have 50 tickets, damn, I sold one more, my value at risk is now $1 million. What would happen if I say, you know what, I'm gonna give the 50 tickets I just sold to 2 of my friends. One gets 25 and the other gets 25. Yes? So I got nothing. What's the value at risk of my friend with 25 tickets? 0. What's the risk of my friends with other 25 tickets? 0. So I made risk disappear. Right? Well, we know that. Okay, so that's coming back. This is, by the way, this is what many companies did. If you have some risky portfolio, you put it on a special purpose vehicle and you just make the risk disappear. In a certain sense, a lot of this is what caused the credit debacle of 2008. But that's coming. Okay, you see? We're getting deeper into something which is completely new. We've never dealt with that before, and we've never dealt with people doing illegal things before. We're going to be dealing with people doing illegal things before. But let me go back to the definition of value at risk and tell you how these things are done. The first thing you need to do is you need to generate scenarios, as Tom was saying, right? We need to generate scenarios. You were saying that. You are actually giving me exactly how I generate the scenarios, which I need because it has to be written in the law. And then I calculate my portfolio with the scenarios are done, and this is what KPMG does. And then once I have that, then I have my statistical description of and then I look for, if it's my value at risk, that will be what? You can probably not see that if you're here, but people on Zoom could probably tell me visually what is the value at risk of this portfolio. Can you see people on Zoom? I think it's not that. Well, if you look at that number, you can see that the value at risk of this portfolio is about 6. Why? I tell you, I have 100 scenarios there. If I have 100 scenarios, the value at risk is the 5th largest loss. The largest loss is about 10, the 9 is about 6. Right? Which means that the rest of the events there don't matter. So, to mathematicians, this could be slightly disconcerting. But let me try and bring in some math to see how we can do this in specialized situations. That's the probability of my losses. It's given, if my portfolio is a Gaussian portfolio, why not? Let's assume it's a Gaussian portfolio. Then that will be the definition of my value at risk, and that's the way to calculate the value at risk, where phi is the cumulative distribution function of the Gaussian, right? And this is all in the risk matrix methodology proposed by J.P. Morgan in 1994. But the quantile of the Gaussian is known. The 95% quantile of the Gaussian is 1.65. And the 99% quantile of the Gaussian is 2.33. Goes back to your question, whether it was 5% or whatever it is, we know. That means that if my portfolio is a Gaussian portfolio, I can calculate the value at risk as a multiple of the standard deviation. The standard deviation multiplied by these universal constants will give me the value at risk, if my portfolio is Gaussian. Yes? All right. I have an example. Imagine I have a portfolio with one asset, 5 million. I'm just going to go through this quickly. You know how to do this. And I imagine that I know the volatility of the stock for a one-day period. Then the 95% value at risk will be 1.65 times the $5 million of the asset times the volatility, which is 0.0298, which is $246,000. That's my value at risk. That's how you would do it. And now I did this, how? I did this with the standard deviation. I did not do this by counting days according to what the law says. Guess what? There are different chapters in the regulation, and sometimes in the regulation, they actually say that you can do it like this. I once had the opportunity, I was part of a committee on the Ontario Securities Commission, where the Ontario Securities Commission was actually coming up with some legislation that required asset managers to report the standard deviation to customers. But that's a big problem, because in the definition of the standard deviation, what is it that you have to do? You have to look at observations, how many, divide by what? How do you calculate the standard deviation? Anybody knows how to calculate the standard deviation? How do you do it?
Square root of variance. Sum of expected minus actual over the
Yeah.
square root of the expected minus mean squared, and take the square root of all of that.
Exactly, good. So all of those terms that you just said can be written into law, right? But what do you divide by, n or n minus 1?
N minus 1.
You have to define that, right? And what do you look at, daily observations or monthly observations? You have to define that. And is it 2 years or 5 years? You have to define that. It was very interesting because in this particular case, it was, well, I won't describe the context of that meeting, but the regulator wanted to change the history from 2 years to 5 years. That's a big problem, because all the systems have been developed that do 5 years, and now you change into 2, then the following things are going to happen. First, you need to hire people from this class to go and do the changes, right? But worse, now you're going to have customers who said, wait a minute, yesterday you told me this was the standard deviation, now you tell me something else. You can get sued. You're going to have to hire people not from this course to attend the call centers, because people are going to be calling you. Understand? I want you to be aware of all of these things that go around the business. I told you we stopped working for free in Reading Week. But if we're going to work for money, all these things have to be taken into account. And the concept of a call center is something that suddenly becomes important, not just lawyers. You understand what I'm saying? I want you to understand everything. Okay, let me continue. And then you can have the 1 year 95 value at risk by multiplication by the number of days. Is that correct? Well, you have to write that down in the logistics of how you calculate these things. So all of these things are encoded. And then you have people who implement these things. And then you have people who verify these things. And this is the job that many of you are going to be doing. I want you to understand that. This is very old. This is the jobs that existed 20 years ago. But today, the law has not, the law has changed, but still the concept of the law has not changed. Laws are written, your laws have to be followed, and banks have to implement these things, have them verified by the regulators, and that creates the whole ecosystem of which you will be part of. And this is the reason why some of you will decide to become lawyers. It makes sense to you. Understand? All right. Now, imagine I go into higher dimensions and I'm going to work with multivariate Gaussians. Multivariate Gaussians are nothing to you, but they're a big deal to many people. Now, suddenly, you know, a matrix and a vector and a graph like that throws many people off, not to you. But you know how a multivariate Gaussian works. You have this is for two. You have a correlation. You have expected expectations of each of the variables. You have the standard deviations of the marginal distributions, yes? So you know that. And then you have the vector of expectations, then the variance covariance matrix. And you have the n-dimensional version of that with exponentials and matrix multiplications and vectors and all of that. Well, imagine writing the law for this. Okay, so from going forward, every time you see a math formula, if you're going to be the financial sector, I want you to think the legal aspect of that. Be aware that many of the things that you do will have a legal aspect, right? Especially when it comes to risk management. So I'll just go on. And the variant of what I told you earlier of the one-dimensional Gaussian, if I have a portfolio of multivariate Gaussians, the sum of those assets, the portfolio of those assets, is also going to be a Gaussian, which is going to be distributed by this multivariate Gaussian. And it has a mean, which is linear, and it has a standard deviation, which is given by the very well-known quadratic expression. Okay, so portfolios of Gaussian variables are Gaussian. This is fantastic because it allows you to do value at risk for Gaussian portfolios, even if they're multidimensional, with exactly the same expression as we had before. And this is, in a certain sense, what the risk matrix methodology was of 1994 done by JP Morgan. Okay? It assumes that the portfolio is going to have a certain Gaussian return. And note this, imagine you are dealing with a portfolio which is a portfolio of options, derivatives, for example. We know that because of the Taylor expansion of the portfolio, the value of the portfolio tomorrow will be the value today, plus the linear change, which remember we call it the delta, remember from before? And then the quadratic expression, which had a name, was the gamma, remember? Okay. And then maybe higher order terms that we didn't see, so we're going to stop there. So this portfolio will be a combination of that. That's my portfolio. That's the value tomorrow, which I don't know. And that's the value today, which I do know. KPMG will give me the value. And these are the portfolio sensitivity. So the portfolio sensitivity could be thought of as a way to approximate the value at risk of my portfolio. But it's an approximation. It's not going to be the one number that I report to the regulators. In case of bonds, there's an expression which is the analog of that, and that's the derivative of the value of the bond by the interest rate, which is the factor that matters for bonds. That's called duration, but it's also the same thing. It is the sensitivity of my portfolio to the risk factor that matters. And from here, we have another quantity that was proposed as part of the risk matrix methodology, which is the delta normal value at risk, which is if I can approximate my portfolio by its linear expression, forget about the gamma, just the linear expression, then the linear expression is a Gaussian if my factors are Gaussian. Gaussian factors are important because they can be written into law very easily. Right? Imagine if they were this student or something complicated, very difficult to write into law. But these are easy because they are formulas that come as a result of all of that. Then my value at risk will be again expressed with those universal constant 1.65 times the standard deviation of something that I can calculate from the delta of the portfolio. So these are variants of everything that we can do. I have an example here. I have two stocks, 5 million in one and 8 million on the other. I have the standard deviations and the expectation of each of them. I have the correlation, 0.67. Then the daily volatility of my portfolio is this, $210,000. All of these things are things that I can calculate using very simple math, right? And this is part of the risk matrix methodology. And these things can be written into law. We went through the Greeks before the break. Now, here they show up again, but now they show up again in a different context. Before we were concerned with option pricing. Now we are concerned with portfolio changes, which is what risk management is all about. So the delta, we saw that, measures the changes to one or several factors, could be a number or a vector. We have the gamma, we saw it, it's the second derivative with respect to the vectors, to the factors, could be one, or could be a matrix, a Hessian, if I have more than one risk factor, right? How would you define this legally? How do you find the derivative? It should be complicated, right? Well, how about if you do this? I say, well, to calculate the derivative, I look at the value of my risk factor now, and then I increase that by 0.01%. I measure my portfolio then, I take the difference and I divide by 0.01%. That you can define legally, right? And what's the name of that? That has a name, it's called the DV01. It has a name that is the version of the derivative, except the derivative you cannot write into law, but this thing that just said yes, you can write into law. Right? You understand? It's the discretized version of the derivative. But you have to give exactly what the value of the epsilon is, 0.01%. And then you can make it into law. This is very significant. I want you to understand this. Because this is how many of the things we have learned here actually get, this is how you will bump into these things in the industry. If you're doing things which are unregulated, you can do, you can buy and sell, whatever, but you decide the price, then you can do whatever you want. You can do strange neural networks, no problem. But if you're calculating some of these values, you have to follow the rules. And if the rule says there's a derivative, check how the derivative is calculated. Very likely it's a DV01. You have to take this plus 1 basis point divided by 1 basis point, and that's what it is. No room for creativity there. And you have to make sure that implementation is exact. See? And this is how you can start to differentiate between the different jobs you can have in the financial sector. Is it a job you can use whichever neural network you want, or is it a job where you have to make sure that everything that's implemented is 100% correct? Guess where most of the jobs are? Make sure it's 100% correct. In banking. In asset management and investments? What's your guess? No. If you're a lawyer, it has to be 100% correct. That's your work for lawyers, right? For you, there's leeway. You buy and sell, you make a mistake, you pay too much, well, sorry, your bonus is gone. You see what I mean? So I want you to understand that your professions will have an intersection with math, but also an intersection with the law, how these things are implemented. So we have more, we have the Vega, we already went through that 2 weeks ago. I'm just gonna go beyond this, one, okay. Theta, we went through that, same thing, and everything that we saw now before now has a version of it here, but the version is the one you need for risk management, is to understand changes. And now comes a very important question, which is Tom said earlier that the way to calculate value at risk is I'm going to look at the portfolio values through mythical changes through history. Yes? and then I'm going to see how the portfolio changes work. Great. Someone might say, but that's great, and that's what I'm going to do, and that's going to go to the central bank, and that's what they want, that's what I have. But imagine you're going to be a risk manager not for regulatory-driven reasons, but for internally driven reasons. And someone says, well, this is great. We have a portfolio that, throughout history, it would behave very well. But how do we know it's going to behave very well tomorrow? Regulators are satisfied. They are very happy. You get the number, oh, that's exactly right. Okay, perfect. And they file it. But if you want to account for things that might happen tomorrow that you didn't account because they've never happened in the past, that's what good risk management is, isn't it? But now we're going to be risk managers, not for regulatory reasons, but for internally driven reasons, and there is jobs like that too. In that case, what you have to now do is you have to generate scenarios of what might happen tomorrow that have not necessarily happened in the past. Because you understand that your job is not only to satisfy the regulators, but to do this too. For that, you'll have to be a bit more senior. If you're very junior, you will be told, do this or do that. But you're above, if you are, say, the chief risk officer, you have to understand that some things you do for regulatory reasons, some things you do for internally driven reasons, because you don't want your bank to go under, right? Or there's a transaction that in history looks great, but looks very, very iffy. And then you say, well, can someone generate something that might happen tomorrow that we've never seen? And that's what Monte Carlo is. Monte Carlo is a way to come up with scenarios of what might happen in the future that you have not necessarily seen in the past. You understand? It's a very, very big deal. And it's something that you have to do to understand for the unknown. Okay, so I'll just go through this very quickly. And there's a mathematical foundation to this, which is a question I'm going to ask you. And I'm going to give you a few seconds to think about it. If I give you a distribution, let's say that is even the historical distribution that we have observed, or something, or a distribution. Well, this is my distribution plus these, weird things that might happen. How can you produce observations that will fit that distribution? The distribution is given; it's a function, rho. How can you produce samples that will follow the distribution given, that account for unknown events with the likelihood given by the distribution, 1%, 2%. That's good. How do you do that? It's a mathematical problem with a very simple solution. You may have seen it. And the answer is, if I give you the cumulative distribution function of the probability given, the only thing you have to do is you have to generate random numbers on the y-axis, random, which is 0, 1, uniformly distributed, and then send them back through the inverse of the function f. That's how you do it. You have seen that. It's called Sklar's theorem or something. Okay? So the quantiles on the y-axis and the variables are on the x-axis. So if you use f inverse will map uniform 0, 1 numbers into random variables given precisely by the distribution given. But this is the cumulative distribution function, which is the antiderivative of the Gaussian. The antiderivative of the portfolio density given. Okay? You know that. You know that. So you can use this to calculate scenarios, to build scenarios with any probability given. The only thing you need is you need a very good random number generator for the y-axis. You need to be able to generate good random numbers between 0 and 1. That's called Monte Carlo. Yes? Okay. That's Monte Carlo in one dimension. How about in several dimensions? Well, in several dimensions, what is typically done is you generate random vectors which fit a Gaussian distribution. So let me just go through this very quickly. I assume you know this. You probably have seen the Cholesky decomposition, which is essentially the square root of the matrix, essentially. Okay, and you can use that to to generate random numbers for Gaussian distributions. The Cholesky decomposition is a way to decompose your covariance matrix into the product of two matrices, one which is lower triangular, one which is upper triangular. And lower triangular and upper triangular matrices are fun because they're very easy to work with computers. Linear algebra is very time consuming. But if your matrix is lower triangular or upper triangular, linear algebra is not time consuming, it's very fast. That's why you like them, for computational reasons. I'm assuming you know that. And if you have a multidimensional multidimensional variance, you have a multidimensional Gaussian variable, you can change variables from your canonical base into the one given by the Cholesky decomposition. Because then the Gaussian random variable decomposes. Essentially, your random variables are now independent of each other. And what you have is that the variance covariance matrix of the transformed variables is the diagonal matrix. And if you have the diagonal matrix on the exponential of the Gaussian, it breaks down as a product of one-dimensional Gaussians. So computationally, even more efficient. You just need to triangularize your variance covariance matrix. I'm assuming you've seen that. Okay, so I'll just, I think I'm gonna, and the concept of principal components, which I described to you earlier, a few weeks ago, comes up again. But comes up now, not to understand fixed income markets or equity markets as it did earlier. It comes up to give us computational efficiency for the generation of Monte Carlo scenarios. And we talked about music some while ago. It's the same thing all over again, but now applied in a risk management concept, not in a portfolio context. And I'm going to end with one concept, which is the concept of the copula, which is the following. And I'll rush through this, but then I'll pause and I'll tell you why this is very significant. If you're dealing with distributions which are not Gaussian, in one dimension, it's okay. You can figure out ways to deal with them. And Sklar's theorem, you can generate Monte Carlo methods to deal with one-dimensional variables are never a problem. But once you go into multi-dimensions, non-Gaussian variables can be very problematic. And the reason is not because the marginals are always going to be, they're one-dimensional, they're always an issue. They're never an issue, always easy. The problem with multi-dimensional distributions, if they're not Gaussian, is that we don't have a covariance matrix to guide us the way. And the dependent structure between the variables is what kills you. It's what kills you. The best example of that, which is what I'm coming to now, is what happened in 2008. We will see in 3 weeks how you can make risk disappear when you have a portfolio of assets, in this case, mortgages. And when I say disappear, I mean disappear according to standard measures of risk. You have to become very smart to see that the risk didn't disappear, it's now been hidden, okay? We will see that. But imagine you have a portfolio of mortgages, 100 of them. And imagine I sell you a product, it's a derivative, which says, of the portfolio of 100 mortgages, the first 5 defaults, I take care of. I pay, no problem. You take the risk beyond 5 defaults. The first 5 I pay for. Then you do the calculation and say, oh, that's very cheap. So you buy that portfolio for very little money. Understand? That's what banks do. Banks have very large mortgage portfolios. My mortgage, I don't know if you have mortgages here, and what they do is they package them and sell to someone else. The banks take the first losses and the others just sell to others. And what happened is many people thought that the risk of that was very low, because for that you need a very big number of defaults that has never happened right? If the default rate is say 1% and I'm buying the first 5, so, that's 5% out of 1, which is the normal. That's 5 times the standard deviation. It's never going to happen. What happened in 2008? Entire neighborhoods defaulted. And then you had portfolio of 100 mortgages in which 60 defaulted, not just 6. And you bought that risk very cheap. This is what was called a toxic portfolio, yes? We haven't seen those in detail, but you can understand. And as a derivative, that's a very difficult derivative to price, which we have not seen. All the derivatives we saw in the first half of this course were market-related derivatives. The credit ones are the ones that we'll be talking about next week. Very difficult, and the reason is that the risk that you're trying to quantify is the dependent structure, which the correlation does not account for. So the copula has been invented as a way to attack that. And the copula is based on the fact that if you have any, I'll simplify it. You can always assume that your marginals are uniformly distributed. You can always assume that, because you can always transform your distribution so that the marginals are uniformly distributed. We saw that earlier. So if I can understand all the possible ways in which multidimensional uniform distributions are related to each other, then I understand all possible dependent structures. And that's what the copula is. It's a function that maps the unit cube in Rn into the unit interval. Every function that does that mapping is a copula. And every function that does that mapping corresponds to a multidimensional distribution, and every multidimensional distribution has this function attached to it. In particular, that's the distribution that you have by inverting the marginals with their own cumulative distribution function. That's the copula. Then finance in the 2000s gave people the power to think that you can understand now non-Gaussian dependent structures through copulas. It is true. It's true, because this explains every possible dependent structure. Problem is, there's infinitely many of them. So modeling was done, and certain of these marginals were created, and the result was this. The result was that there was a very good mathematician who created the pricing formula for collateralized debt obligations using the Gaussian copula. The Gaussian copula is not a Gaussian distribution. It's a copula which is very easy to deal with, as easy as the Gaussian distribution, but allows for non-Gaussian dependent structures. I will not get into that. So he created that. David Lee from Waterloo created that. And that became the de facto method that every bank was using to construct mortgages. It was better than the Gaussian, but it was not good enough to understand what came in 2008. The result was what we know. A lot of these mortgage portfolios blew up, and I like this newspaper article because it's totally wrong in their understanding of what happened. So I encourage you to read it and see how many things you disagree with in it. There are very few things which are correct in that statement. It doesn't matter. This is what people think. That's what newspapers wrote, and that's what many people who know better. That's what they think. But I encourage you as an exercise. I'm not going to do that, okay? But I encourage you as an exercise to read through this article, put it into the context of what I told you. Should I see what's right and what's wrong? But you have to do this on your own, okay? Okay, great. So this, we're going to take a break now, another 10-minute break, because what's coming after this is the science fiction part of this class today. I'll talk about what's coming next. And I will do that in the context of the discussion about sustainability and climate risk and all of that, but I will put that into the right context, because what I'm really talking about is, I'm talking about large language models and what they are going to be doing for us I will just use climate risk as the context, because it's much easier to express. Okay, 10 minutes. What remains of this course is challenging because there's so much I want to tell you, and there is very little time. And I've chosen to pack things in a certain way, which I don't know if it's optimal or not, but it works. I want to do something now that is going to be a blend of two things. I expect to kill two birds with one stone. I expect to tell you about a new trend that's happening in industry, but in particular in the investment sector, and to a certain extent in the insurance and banking sector too, which is this whole discussion about sustainability and climate change and this and that. I'll try to tell you as much as I can of that, but I only have 45 minutes, less. I have a bit more than half an hour. But I also want to tell you the role that artificial intelligence, machine learning, and large multimodal models are playing in the sector today, and I expect to do that with this in this half an hour. I'll see how much I can accomplish. So I start with sustainability. You probably know what it is. There's 17 Sustainable Development Goals dictated by the United Nations. These are things which have been classified into different pillars, which are very relevant in the financial sector. The E pillar, things that have to do with the environment. The S pillar, things that have to do with social impact. And then the G pillar, which are things that have to do with good governance. And I like to put this into perspective of what happened with and the Harvard Endowment Fund. Harvard Asset Management is, Harvard University has the biggest endowment of all universities in the world. Today it's at about 35 billion. Just to give you an idea, U of T is a few billion, 2, 3, something like that, not very big. Okay, so Harvard is like 10 times the size of U of T. And they make one decision in 1990, which was to divest from tobacco stocks. They thought that tobacco stocks kill their customers, it's a bad business, they don't want to be in it. This was the time when tobacco stocks were the most sought after stocks by hedge funds. So here comes Harvard and says, you know what, we want nothing of that. Very profitable companies, they produce things for a penny, sell them for $1, but we want nothing to do with it. It so happens that tobacco stocks starting to be sued after that. They still became very profitable despite the lawsuits, but there's a way to look at what Harvard did, which I want to use as a way to get into the sustainability considerations, which is what they did in a certain sense is give up the profitability today for a whole host of risks that you don't really know that might happen maybe 30 years from now. That's what you do. So in a certain sense, it was a very good risk-driven decision to get rid of something that was very profitable because there's a lot of uncertainty as to where that business could go. This is exactly the reason why ESG and impact investing has developed. If you're investing in companies that, for example, harm the environment, they harm people, then you just don't know to what extent this could come back and hurt you reputationally, legally, and for decades now, smart companies have been trying to get into this somehow. Okay, I have here the picture of the evolution of a tobacco company, British American Tobacco, and the S&P 500. So, and this starts when Harvard made their decision to not invest in tobacco. So if you look at this chart, the S&P 500 is in orange and the tobacco company is in blue. You might think that their decision was good because the S&P did better than the stock for about 10 years. But then you can see that the situation reversed. And it was only around 2018 that you can better understand, better grasp the driver for Harvard's decision. This was when social elements became important in investment practices. And this is the reason that the stock underperformed the S&P 500, and the reason Harvard did what they did. I have a video here. I don't have time to show it to you. Maybe I
Truth. This is Democracy Now!,
I'm here.
democracynow.org, The War and Peace Report. I'm Amy Goodman with Nermeen Sheikh.
We turn now to Harvard, where students are continuing to blockade key administration
This is
offices
what's
while
happening at
calling on
Harvard
the
today.
school to divest from fossil fuels. Harvard has the largest endowment of any university in the world at $36.4 billion. The protest...
So I'm going to end it there. But this is Harvard 1990, and this is Harvard today. And back then, no one was protesting about tobacco stocks, okay? It just happened as a surprise. But now everybody's protesting about the fossil fuel industry, this and that. And this is affecting businesses, affecting investment decisions. And in a certain sense, I want you to understand one thing, which is that all of these things that are being discussed are risks. In a certain sense, it's like a new liability. You have to account for whatever can go wrong, including the fact that you can get sued and this and that, and treat it as such. So this has created a distinction when it comes to investments about companies that are, so to speak, normal, or companies that actually benefit the environment, which are somehow safe from an ESG perspective, environment, social governance. In the case of environment, anything, green power stocks, water supply companies, renewable energies, all of these are very attractive from social reasons. Okay? Of course, if someone discovers the way to produce hydrogen, if you have the hydrolysis challenge solved, and you find the molecule that stabilizes hydrogen so you can store it in very small containers, you'll become immensely wealthy. Like this will be perhaps, this is better than artificial intelligence. That will be like the biggest revolution right now. And many people are betting for that, because if you can come up with that, then you actually get rid of fossil fuels, but for economic reasons, they're too expensive. This is free and easier to transport, you see? So there's a lot of that being created. Still, people say that one of the best businesses ever created was bottled water. More profitable than bottling oil, right? So there is considerations which investors are very aware of these things. When it comes to social elements, community impact, the impact on minorities, these are things that could hurt you. We went through a period where these things where investors were running away from companies that had a negative community impact or negative impact on minorities. Now, as you can read in the news, we're back into say, I don't care. But the risk is there. And if you're an endowment that makes decisions 30 years into the future, think of that picture that I showed you of Harvard and the tobacco stock. You need to be able to be alert to these things, because there's risk there that you may not want to be part of. And same thing with governance. You can say, I don't care. I invest in this company which is completely corrupt. Well, the company may be in trouble, but you may too, even as a shareholder. Okay, so there was a case last year, or 2 years ago now, that the board members of the Shell Corporation in the UK were personally sued by someone. It's very unlikely that's going to go anywhere. It's very unlikely. But again, this is part of the risk considerations, and this is risk that could be under the heading of legal risk, not credit, not market, not liquidity, maybe legal risk. So you just don't want to be there. And so the way this thing is addressed today is through ESG scores. I don't know for how many more years we're going to see these things. They have a very bad press. They've been, I'll say something more about ESG scores. MSCI is one of the biggest suppliers of ESG scores today. And what they do is they measure a company's management of financially relevant risks from the point of view of the environment, social, and governance perspectives, okay? And they're giving ratings, AAA, AA, very much like the credit risk ratings we will see next week, but in the case of E, S, and G. This is what the typical classification table looks like for companies of this type, okay? I'm not gonna get too much into this, but what I want to say is the following. Let's again reflect on the last 100 years of financial innovation. Let's try to put this into the context so we can guess what the future might look like. And this is what I want you to understand. In 1930, when value investing was created, the relevant data that mattered was what? Company accounting information. But that you can actually write with a pencil on a piece of paper, because there were no computers. When computers came up, then time series became the issue, right? For a long time, we've been working with numerical time series and the numerical methods in the year 2000, but what's happening now is what I said earlier. And the example I want you to take into account here is GameStop. I like to talk about GameStop because GameStop is a very good example of what I think is to come. You know about GameStop, I don't have to tell you, right? Well, what is to learn from GameStop from a data science perspective?
Like scraping the Reddit threads that was talked about rather than looking at.
If you want to understand what happened with GameStop, the answer is not on Bloomberg. The answer is on Reddit. Okay? And for me, that's a fundamental change. The data that matters is textual data, is not numerical data. That's what's happening now. By the way, that's the way to deal with sustainability as a risk factor. But it's just one example because investments are going to be like that. If you can understand consumer sentiment analysis, let's say that GME was a case of consumer sentiment analysis, then you can be ahead of the curve. And consumer sentiment analysis was done in a very complicated way with expert networks and this and that in the past. But now, if you had access to Reddit in real time, then you can make very good decisions, right? I would argue that the best investor today is not going to be a Warren Buffett type. It's going to be Google or Facebook or Reddit because they have the data, right? Imagine an algorithm that says, let's see what people talk about in a positive way and I buy it, and in a negative way and I sell it. That's it. Forget about risk neutral measures and all that stuff I told you, right? So let's get into that because numerical data is the thing of the past. Now we're working with textual data. That's what I'm talking about. And there's more to come because soon we're going to have sensor-driven data. I'll give you examples of that. And images, satellites, videos. Imagine what investments you can do with that, right? Yes?
If we're relying on like textual sentiment methods, then people can take advantage of that and manipulate. And so they make everyone believe in the wrong information.
Exactly. You should come here and tell us about that because, no, this is exactly what I'm talking about, right? Remember the case of this guy, Albert W. Wiggins, the CEO of Chase Bank, right? It was legal. Can you trade on the information if you run your own social media platform? I'm not a lawyer. You see what's happening, right? I'll give you an example. There was a question. I'll give you an example. You know Warren Buffett? Yes. Warren Buffett made one company very popular, Krispy Kremes. Remember that company? Anybody remember that? Have you ever eaten a Krispy Kreme? Yes. I think I never ate a Krispy Kreme. I never had a chance. I don't like this stuff anyway. But you know how people invested in Krispy Kremes? What they did? I know people who do that for a living. What they do is, this is the investor, right? They drive on their car and they typically are sold in shopping malls. And I'm talking about the United States. I think they sold them in Canada too, but I'm not. So they go there and they sit on the car and they look at the lineup at the Krispy Kreme and they make a table and they analyze the demand for Krispy Kremes and that's how they decide if they invest or not, right? You can do that with a drone in real time today, right? What's the data? The data this person was doing was numerical data on a sheet of paper. But I can do that with drones in real time, right? much more accurate, even than someone with it. And this is what's changing. I'm going now beyond text into sensor-driven data or satellite images, right? There was a question? Yes.
Oh, like back to like the textual data thing, right? Depending on like you said, talk about like sources and stuff, right? And sentiments. Like depending on the source, right? Like there's gonna be different biases, right? Is that like part of the job to like determine like what the
I didn't
overall-
say that if you have the data, things are easy. I didn't say that. They will need to hire people like you to extract value out of the data. But what I'm saying is that when you have the data, you can compete with the people that don't have the data. Because I'm not saying that you're gonna buy or sell Reddit, buy or sell a GameStop, ignoring what's on Bloomberg. No, of course you do. You still have Bloomberg. You're not giving that data away. You're not ignoring that data, but if your data set increases, your decision will be better. You know that. And that's what's happening. Right? What the algorithm that you follow, that I don't know. That I don't know. But with bigger data, your decisions are going to be better. This is an example of something that we did with one of my students. This is years ago. We analyzed companies by looking at their tweets that mention the company. And we classify them according to different characteristics, and then we see which ones are good, which ones are bad. You do this with NLP. You don't even need large language models. This is very easy, right? We did that. So I can give you a score. This is the way to do scores. This is the way to do a score for Facebook. And this is the way we did score for Starbucks. And we can pick the categories, and computers can do that. No one is doing this. Well, sorry, that's not true. The standard is not to do this. The standard is to go through these wholesalers of ESG scores, and that's what people, but you know that the best way to do it will be like this. You can do this in an hour yourselves, right? And that's if you want to be careful. You don't care, you do it in 20 minutes. Yes? And I should say that this is the company of one of my former students who used to be sitting in this course maybe 20 years ago, Alex Sokolov. He has a company called Sibley, and that's one of the things that they do. So in real time, they can give you these ESG scores done by machines automatically, going back as much as you want, with proper sources of data. That could be media, could be social media, could be Bloomberg, whatever you want. This is what's happening. This is the present, and maybe a bit of the future. And this can be used for ESG, can be used to do sentiment analysis, or can be used to do smart risk analysis when you take into account things that no one even knows that might happen. And I want to end with one example. This is a very interesting case of a trade. This is the type of trade that is going to be your future. I am pretty sure about that. And it's very surprising. This is a tribe in Australia that gets paid to burn the forest. I'll explain. They are in East Kimberley in Northwest Australia. That's where this tribe is. And in Australia, wildfires occur during the late dry season, August to, and when they happen, they are vicious. They burn at scale for a long time, and the result is catastrophic for the savanna, but also for the animals, and also for the emissions, the CO2 emissions. So what they did is they reversed the situation by doing what's called controlled burning, and there's a method for that. And it's been happening since the year 2017. And what they've noticed is that the area that gets burned every year decreases by 33%. They've noticed that grass and wildlife are back, and this is documented. But this is the interesting part. CO2 emissions have been certified to decrease by 40%. Let me now have something important to say. Area being burned decreasing by 33% sounds like this is great. Grass and wildlife coming back is even better, right? But what they get paid for is for the decrease in emissions, in CO2 emissions. That's what they get paid for. They don't get paid for the rest. They get paid for that. Why? Because there's a market for that. Today there's a market. If you decrease emissions, you can get paid, and if you produce emissions, you will probably have to pay in one way. This market is still nascent, it's still being developed. And perhaps I want you to understand how that happens. But the most important part is look at all these documents that are coming up on the screen. Just look at them. These are just individual screenshots of hundreds of pages of documentation. This is regulated documentation. These are things that this tribe, the Nyaliga Corporation, had to hire a consultant to do, and as a result of this, you get paid. This is like accounting. This is like the risk management that we showed earlier, but of a different type. The difference is, earlier, we were trying to understand how we can encode value at risk into law, right? Now, what we have to do is much more complicated. We have to figure out how to encode your emissions reduction into documents which are interpreted, which are vetted, and the result of that is you get paid. How do you do that? How would you do that? This is not how it's done. How would you do that? With large language models. Large language models can do this for you, as you know. They're not being used. Because of that, these trades, they take a long time to do, months. Because these things take a long time to be written, and they're written by humans. Right? So now I want you to be in a science fiction situation. Imagine every project out there that could decrease emissions, for which you get paid. You get paid about, depends on where you are, let's say $10 a ton. Let's say, right? Well, let's say that you can do a project that is going to remove 1 million tons of CO2 per year. That's $10 million a year, right? What do you need to do to collect the $10 million? What do you need to do? You need to go through a process of validation, verification, disclosure statements, audit reports, and this and that. If you could automate that and trade it as quickly as you can buy or sell stock today, that business is a good business. This is what the Paris Accord says. That has to happen. I don't know which way it's going to go, especially now. There are parts of the world where these things matter a lot, like China, for example. There's parts of the world where, for example, the United States, they say they don't care. There are parts of the world, Europe, they say they care about this a lot, but they go very slowly. We will see. But whether it's for emission reduction or whether it's to do sentiment analysis or to do any of that, the technology that you will use for that is the same. And this is your technology. And this is new. It's just been introduced. And if you can produce documents like that quickly, if you can understand documents like this quickly, and you can trade on these things quickly, this is a new business. I'll give you here the projected volume of the carbon markets. I don't have time to explain to you the carbon markets, but you understand what that would be, right? We're still at the beginning of that, at $10 a ton, probably more. And I'll tell you another interesting aspect of that, which is, do you know the commission for trading a carbon market, a carbon credit? 50%. Anybody trade stocks here? Anybody has trade stocks? No one? Yeah, you trade. How much? What percentage commission do you pay?
Whatever the return is.
No, the commission when you buy and sell.
Oh, like for example, it could be like $5, or if like you were on Quest Trade, it's like $5.
$5 per trade, and the trade volume.
Maybe like 20 cents sometimes.
Okay, and so 20 cents per. What are the units? Let's write it in percentage terms. 20 cents per share,
Yeah,
okay?
whatever it may be. But it caps usually.
It caps. Okay, so let's say worst case scenario in terms of how much you would pay for the craziest, most expensive stock trade would be what?
Well, if you short, then sometimes there's like shorting fees.
Yes.
Like overnight rates and stuff like that.
Yes.
Like me personally, nothing crazy.
So even if you short, the fee is 1%, typically, less than 1%. 50%, 50. That's how inefficient these markets are. I told you, we stopped working for free. 50%, right? So these are the new markets that have been developed, and these are markets that cannot function without math for sure. They cannot function properly without technology. These are like the most incomplete of the incomplete markets you can ever see. That's why the commission is 50%, right? And again, could be on carbon, could be on consumer sentiment, could be, but this is where things are going. And of course, the law being behind all of this, making everything work, right? Yes, question?
So why is the commission so high?
Because it's very hard to find a buyer and a seller. Yes.
Is there a market for like brokerages that would do that then? Why is that not?
There are a few more, no, brokerages, that's what they charge.
Right, because like for regular exchanges, like there's
No, the exchange is practically free. But the thing is, when you have this is the voluntary market, right? I'll give you an example. Anybody, when you fly Air Canada, for example, do you buy the carbon offsets from Air Canada? I do. And in fact, U of T, they buy the carbon offsets again. Okay, when I travel, I buy the carbon offsets, and U of T then would buy them again and will charge me for that. So we buy them twice. So I fly with negative emission footprint. That's me. Okay. So their Air Canada on their website, they give you the option. If you buy it, you pay $10. Then what they do is they give the $10 to a company that makes sure that the offset happens. Right? Okay. So this company was able to find me. Sorry, this company, no. This company does not do the offsets. There's probably some developer somewhere in British Columbia that's what they do, and they get $10 from me. Right? They don't know who I am. I don't know who they are. There's all these intermediaries that are connecting the buyer and the seller. And the market is so inefficient that we're happy to pay 50% commission for that. In fact, I've calculated I think the commission in the Air Canada carbon credits is more like 80%. Do I care? No. But that's just to give you an idea of the inefficiency that's built into the system and the new markets that could develop with something like that. Yeah.
So the carbon market, is that like companies buying the right to emit carbon?
Yes. Or in this case, would be the right I have to fly on a certain airplane and being able to represent that my travel was actually carbon neutral.
When they buy the right of this sort of emission, can they trade this?
Yes, there's a market for that. You can buy and sell. Yes, yes, you can buy and sell that.
Like a certificate.
Yes, yes,
So it's like the emission certificate.
Yes.
issued to-
yes, yeah. That market this is your market. And it's beginning now. This is like where stocks were in the year 1700.
That's like super dependent on legislation, right? So like in the US.
Okay,
there's no
okay.
market.
So there's two markets, and now this gets interesting. There's two markets. There's the regulated market, which is dependent on legislation, and there's the involuntary market, which is not. Some corporations do that because they say, you know what, like Apple, this watch is carbon neutral. There's value in saying that today. Just like there's value in saying I don't smoke and I don't invest in tobacco companies. That's the value, right? And it's not that expensive. It's not that expensive. I mean, the surcharge on my airline tickets is less than 1%. It's about 1%. Not expensive.
The reason there's a market for this is because the government is saying you have to limit
So if a government wants to meet their Paris Accord targets, for example, then they will intervene and will give penalties and rewards to participants to meet the markets. That's what they would do it. But many people do it without having to do that. The voluntary market is voluntary, and still is very active. Yes.
Is that like cap and trade dynamics kind of thing?
Cap and trade.
Yeah.
That's the regulated one.
Okay, that's a
Yes.
okay.
Yes.
But if it's not regulated, why would you buy the right to emit in this emit, right?
No. If it's not like, sorry, to buy the right to emit, that's the cap and trade. That's the regulated.
Yeah.
I'm talking about, this is the voluntary carbon market, as you can see. That's the unregulated. People do it because, I mean, look, I pay to, I pay a cleaning fee. I pay to clean my house, right? Oh, why do you pay? Just save it and then, well, no, I chose to pay, right? And many companies, they choose to pay.
But you pay to emit, like.
In this case, you pay to reduce. Like, think when you're traveling, right? When you're flying somewhere, you buy the carbon, and now your travel is carbon neutral. In my case, carbon negative. Why do I do it? Because you think it's the right thing to do. It's my choice, right? Well, many companies do that too, right? This is a social trend. People do that because
So like for ethical reasons.
Hmm?
Ethical reasons.
Ethical reasons, like why did Harvard divest from tobacco stocks? Because they thought, I don't like this. At first I don't like it, and there's liabilities. Maybe one day this is gonna say, well, you know what? I don't need the stocks. I just buy these other ones. They're better, right? And for 1%, you would do it. The cost, of course, if they charge me, $1 million, I'm not gonna do it. I don't have money. For $10, I do it, right?
Yeah, I was wondering the relation between the Canadian carbon tax and cap and trade, because it seems there's a mixed message.
Yeah, well, now we get into the implementations of this, and that's always very. By the way, I don't like the word carbon tax. I don't think it's more like a cleaning fee, for me. I don't like the term. I think it's a misnomer. But again, who am I? I'm just a math professor teaching math, right? But for me, it's like a cleaning fee, which governments are doing that because they want to be there. For me, the best example is China. The extent to which they're going to have a clean industry. And the reason is, I don't know if they would burn coal if they could. The thing is that there's not enough coal in the whole world for the ambition that China has in terms of energy consumption. So you have to be smart as to how you do it. A lot of this is to understand that to grow without limits, you need to clean, right? Otherwise, that's going to give you limits to how much you can grow. I think it's just being smart in how you grow, right? If you have a long-term view, that's what you would do. If you have a short-term view, I just want to meet my next earning expectations in my next quarterly report, and you do whatever it takes.
So you're saying more they're getting ahead of the curve?
Yes.
Not behind it.
Right. Yes, because you just don't know where these things are going to go. If we indeed have a climate emergency, and there's a probability that we do. It's not 100%, but it's not 0%. It's more like 20, 30%. That's very significant, right? And you buy insurance against it, and if the insurance is not expensive, you do it. That's what you buy. I mean, I don't buy house insurance hoping my house burns. I don't know anybody who does. Some people do, but that's, right? Same thing here. It's just part of your budget. You do it, and if something happens, I'm hedged. It's risk management. It's risk management. Because you don't know what's going to happen. You just don't know the impact that these things are going to have. And many companies, they depend on their constituents and what people think about them. Many companies, Apple, for example, Apple cares about what people think about them. You make an investment in what people think about you. And that's it. If the return is good, then you do it. But now you see, how do you measure this? Back to the measurement issue, right? How do you measure the impact of people thinking good things about you? There's no accounted statement that tells you what that number is. You know, what's the value that people think you're good? What's the value? I don't know, but most people I know care about what people think about them, right? And if you spend a little bit on improving people's opinion of you, you do it. Sometimes it's a good business decision. That's what's happening here. How can you quantify this? I don't know. Is there a large language model that can quantify this for me? No. But maybe one of you will come up with a way to quantify this and then call me, okay? When you do that. We'll become famous together. You see what I mean? This is the science fiction part of my talk today. I have no idea where this is going to go. But I want you to see that there's something that hasn't developed yet that's going beyond this, okay? And this has nothing to do with being woke or not. This has nothing to do with that. It's good business.
Right, because I mean, you buy offsets. I know a lot of the cloud data centers are pretty much carbon neutral. They're trying to be. And
Yes.
at the same time, they're using that to tell corporations, oh, you have to go to us.
There you go.
Shut down your own data center.
That's how you compete. That's a very good example. It's a very good example, okay? And this is the new finance. This is the new finance. Driven by risk, by the way, okay? Okay, so science fiction. We'll see where that goes. You call me, okay, when you see something. I end it here. Next week, online.